Hello, welcome back to the channel. So in today's video, I'll be covering stocks that have been falling, as well as some of the stocks that I bought on this recent dip. So for reference, this is my entire portfolio. I updated it. So currently now it's in sequential order already. So my largest position is still Google, and I'll be covering some of the stocks that I bought today from this portfolio here. So the markets have been selling off, and historically September is normally a very weak month. In the entire year, September is typically the weakest month, and that is what we saw in this opening day into September. So what I added today was actually Warrior Met Coal. So this stock is down around 7% today, 6 to 7%. It is currently trading at a 74 times of earnings. So why exactly did I add to this company? And here are some things that I don't think the market has fully priced in yet. So first of all, the market hasn't fully priced in the fact that your blue cracks will increase the volumes rapidly. So them opening up a new mine will massively increase their volumes by upwards of 70%, which is what the management has said. And the management also has skin in the game. So the CEO owns around 0.7% of the entire float of this company. Besides that, he also has a lot of his stock-based compensation actually tied to the success of this entire mine. So that is one part that I'm bullish on as well. Besides that, your coal prices have been depressed for years. So China has been flooding the markets with cheap steel for many years, and currently we're seeing some form of normalization. And if we're able to see a reversion to the mean, which is definitely possible, this will mean a lot of upside for a company like Warrior Met Coal. Warrior Met Coal is also the lowest cost producer in the entire space, in the US at least. So that is a moat that the company definitely has. The next stock that I'm hoping to add to is actually FICO. So FICO is down around 25% year to date, currently trading at a 58 times of earnings. I initiated my position at around $1,350 a share. I'm looking to add on the way down. Hopefully it continually drops. So for FICO, here are some of the TCs for the company, just a very short one. So first of all is that your pricing power will remain unaffected. So competition is elusive. The markets are pricing in that Equifax will take over some market share from FICO, but obviously there's no incentive for your lenders to switch. And so I don't see this as a possible scenario. Besides that, the company will maintain its market share and continually exercise its pricing power by using VantageScore as an excuse to increase their prices. Besides that, the software side of the business is actually one that is neglected by the markets today. So they currently have around 61% of their entire software portion on premise. On premise means that they have to go to the sites of the customer and they have to build out infrastructure there. So this actually drives down margin because they have to customize it according to the customer, and there is no one standardized platform that the customers can use. So the company is continually trying to shift this portion to the cloud. And once we see that happening, once they're able to basically have recurring revenues coming into the company every single year, as compared to a one-time big licensing fee that they get from building out the infrastructure at the customer's place, this will be a tailwind for the company in the form of margin expansion, because your fixed costs will remain the same and your fixed costs will become a larger share of your total cost for the company, which is operating leverage. So next portion, if you're looking to sign up on a brokerage account, feel free to use my Momo link below. It's a referral link and you'll get some exclusive rewards from that. So if you deposit $100, you'll get $20 worth of Nvidia shares. So if you haven't signed up with Momo yet, feel free to use my link in the description. It is free, I'll get a commission off of it, and we'll move on to the next portion. So the next company that I would like to cover is actually an undercovered one. This company was one that I was told to research. So this company is Chuggy. Chuggy is now around 40% year to date, currently trading at a 9 times of earnings, although post its earnings results is actually trading at a 20 times of earnings. So for Chuggy, if you're to look at their earnings, so net revenues increased by around 10%, non-GAAP net income actually went up by 0.1%, and overall this was a disappointing quarter for Chuggy. So for Chuggy, if you're to look into the numbers as well, there's one number that is quite obvious. It is their same-store sales growth. So same-store sales growth is actually down around 23%, meaning to say that each store is getting less revenue, and that is why we're seeing net revenue slowing down. So this is actually bad for a company like Chuggy, meaning to say the company is probably a lot more saturated than it previously was already. So for Chuggy, the company is operating in a very competitive space. It is personally not my investing approach to buy a company like this, although the company looks cheap if it can internationally expand. So the company now is experiencing normalization in terms of its growth. perfectly normal for a company like this. But there's always the concern that they're cannibalizing their profits. So they have a lot of their stores actually in China. Majority of them are in China. In fact, over 80% of their stores are in China. So if they continually expand in that portion, then the quality of their earnings will actually drop, meaning to say their same store sales will continually drop, which is not bullish for the company anyways. Besides that, fads and trends die over time. So it really depends on the company's ability to defend its trend. In the case of Chuggy, they are defending it through international expansion and through expansion of products. So they're trying to venture into ready-to-drink products, which is tied to the Chuggy overall brand. This is probably a decent move by the company, although it's still not substantial yet. The majority of their revenue growth is actually still coming from store expansion. But store expansion leads to cannibalization, which is something that you should be looking at if you're investing in Chuggy. Personally, not my type of investment, simply because of competition. I see this as a high risk, high reward play from here. So that's why I'm avoiding this company. Next stock that I'll be covering as well is Meituan. So Meituan is down around 32% year to date, currently trading at a 19 times of earnings. So this company is a Chinese firm as well. What they do is they're similar to the Uber in the US. So they deliver food and they operate in that segment. But if you have to look at Meituan's earnings this quarter, it was quite disastrous. So adjusted net profit actually went down 89%. Profit for the period actually went down by around 96%. So why exactly did the net profit drop by so much? It's because the company is trying to prioritize market share gains. And that is why I tend to avoid companies like this, because the company is actually facing massive competition from peers. So you're seeing Alibaba coming out with their food delivery as well. You're seeing JD doing the same. And this is the problem with all the Chinese firms. So for Meituan, it's a company that has said that it will be focusing on market share gains, meaning to say that shareholders will have to bear through this pain in the upcoming quarters as well. So we will probably see net income dropping over the next few quarters, which is overall bearish for a company like Meituan. So that's why for me, I tend to avoid companies like this, operating in very competitive segments. Chinese companies are always like this. They love to steal market share from one another, but overall it is a loser's game. Next company that I'll be covering as well is one that is undercovered. It's a company in Singapore. So this stock is actually called Citrum. It's up around 15% year to date, currently trading at a 30 times of earnings. So for Citrum, this is their business model. They construct a lot of these things here. So they construct rigs, they construct infrastructure for energy, they construct infrastructure for ships and all that. So this is the entire business model. So besides the construction portion, they also have the service-based portion, which is around 15% of their current revenue. So they will have service contracts to service all these places, maintain all the places, similar to what Otis does, except that it's at a much smaller scale. So for Citrum, just some napkin numbers. The company currently has a 2.5% profit margin. So if you have to compare to the last boom that they had in 2014, it was actually at around 9%. Besides that, the company's net profit now, the net income is actually only at 265 million. So similarly, if you were to compare it back to 2014, it was at $560 million. So the company just recently had its largest backlog in many years. In fact, it was twice the amount that was present in 2013 and 2014. They had around $24 billion on backlog this year. So if you have to do some math, some napkin numbers, if they're able to increase their profit margins to levels in 2014, that means that the company will probably be able to get around $1 billion of net income in the years coming, which is a 4x from its current position. So this is actually a company that is quite interesting, although the valuation today is quite demanding. So for Citrum, it's a company that operates in your boom and bust cycles. Currently, we're in the recovery phase for Citrum, and we could see the boom again with their massive backlog. So there are two catalysts coming up for this company. First of all is your massive backlogs coming up. They secured a Brazil deal last year. Besides that, we could see rapid margin expansion with cost-cutting efforts from the company, as well as increase in stock base. So the company has committed this year that they will be reducing their cost by upwards of 300 million. So if they're able to decrease their cost by 300 million, that directly flows to the bottom line, which is a double from this current net profit. Last portion, I'll be covering some questions left in the comments. So the first one, it says JPM, Goldman, Morgan Stanley versus DBS, UBS, OCBC, US big banks versus Singapore big banks. So US companies, the US banks, they're more focused on capital gains. Whereas in Singapore, if you're buying all the banks, you're looking for stability, you're looking for dividend income, which is what I'm looking at as well. I think UOB, OCBC, and DBS, they're all decently high quality companies with an excellent track record of dividends. So even during the COVID period, these companies still gave out dividends, which was quite remarkable. So if you're to compare the banks in the US as compared to banks in Singapore, the banks in the US have a lot more ways of making money. So they have the crypto portion, they have a lot of different streams of income coming into the business. Whereas in Singapore, all the different banks, they have limited options for profitability. So they have the net interest income, they have the insurance, they have the trading profits and so on. But it is much lesser as compared to your US banks. So in that department, the US banks probably do a lot better, which is why our US banks are trading at a higher premium as compared to all the Singapore banks here. But of course, I think the Singapore banks look interesting today because the Singapore interest rates are a lot lower as compared to previously. It is currently now at a 1.2%, which is historically quite low, which means that the downside risk for all these different banks is probably over. So I'm looking at UOB as well as OCBC. DBS is a bit too expensive at this price. So those two companies are the ones that I'm interested in. Next comment it says, comment on Cathie Wood's plays. She always gets high returns chasing exponential stocks at an early stage. Famously went into Palantir at $13, Tesla at 130, BMNR at $34, etc. Okay, so Cathie Wood. So this is Cathie Wood's returns in the past 5 years. Cathie Wood's returns over the past 5 years is negative 14%. The S&P 500 is actually up around 86%. So she's trailing the S&P 500 by around 100%. So to say that she gets astronomical returns is far-fetched. I think she does very well when the bubbles start to form, which was why she did very well in 2021. Currently, we're seeing something similar as well, so she should probably be doing well in the next 1 year, 2 years or so. But I don't think she's an investor, I think she's more of a trader. If you're buying her fund, maybe for a trade, it's fine. But this is not investing at all. I hope you guys have found this one useful and invest safe.